Good morning, and thank you, Laurent. So you've heard from Laurent about the actions that we're taking to drive superior, sustainable, and profitable growth. And I'm going to give you a bit more colour on those actions and the financial outcomes that we're expecting to deliver. So let me start with growth. And that's been a key theme of the presentation that you've just heard. Our objective is to deliver 4% plus growth in organic sales. Now we see the food and beverage category growing at about 2 to 3% per annum. And that's consistent with the views of various third-party research providers. Our superior mix, which is greater exposure to the more structurally attractive categories and weighting to the faster growing geographies and channels, adds around 100 basis points to that, meaning that Nestlé's category growth is about 3 to 4% per annum. We believe we can outperform Nestlé's category growth over the medium term through better focus, rigour, and execution. Best-in-class performance requires us to take actions to accelerate our categories and to improve market share. And we're confident that doing this will successfully allow us to deliver 4% plus growth with two riders, in normal market conditions and in the medium term. So let me explain those. Firstly, in the last few years, we've seen that the staples sector is influenced by the macroeconomic environment. So even though the normal Nestlé category growth is 3 to 4%, there will be variability from year to year. So to give you an example, if we see more inflation and category growth at 6%, our objective is to outgrow that. Secondly, we call out in the medium term. As well as we have a clear action plan to restore best-in-class performance, it won't happen overnight. It's going to take time to fully realise the benefits of our plans, as consumer behaviour takes 18 to 24 months to change. So while we're confident in our ability to deliver these growth objectives, it's going to take at least 2 years to fully realise them. In 2024, we're expecting to deliver around 2% organic growth, and that's below the normal category growth rate for Nestlé. Now, there's three factors that explain that gap. Firstly, the category growth has slowed, and it's close to the lower end of the range. Secondly, the inventory reductions that we referenced at the 9-month sales release are weighing on growth to the tune of about 30 basis points. And thirdly, and most significantly, we have a growth drag of 100 basis points or so associated with the impact of market share losses. So of that growth drag, a bit less than half is due to the impact of consumer hesitancy towards global brands linked to geopolitical tensions. And a little bit more than half is the broader loss of competitiveness. And while we're clearly not happy about this, what's critical is that we're recognising it and acting on it. Now, the majority of the underperformance is concentrated in 15 to 20 of our larger cells. Now, by cell, I mean a product in a market, so like pizza in the US. For those 15 to 20 cells, we now have a clear diagnosis of the issues and a plan for addressing them. And Laurent called out some of those earlier. So let me explain what gives us confidence in 4% plus in the medium term. And it starts from an understanding of our category growth. The 3 to 4% is an aggregate number at the portfolio level, but it's actually too simplistic to look at it that way. To really understand the growth potential, you need to drill down. This chart is illustrative of that, showing the zone and category view. But just to be clear, the numbers on this slide show the view on the outlook for 25 to 27 market growth in the categories where we operate. Now, in reality, it's still at a very high level. In fact, our category growth of 3 to 4% is underpinned by a bottom-up view at the level of multiple hundreds of subcategory and country cells. And it's this depth of understanding that gives us confidence in the 3 to 4%. And more importantly, This granular understanding allows us to manage the business more effectively. It informs resource allocation and performance management. So on resource allocation, we're becoming much more specific about where we're investing against those biggest growth opportunities. Going forward, it will no longer be the case that the biggest determinant of investment in a business is the amount we invested in it in the previous year. And it won't be the case that if we achieve efficiencies in one business, they'll automatically get reinvested locally. The granularity of our understanding is informing more polarized resource allocation across subcategories and geographies. We're also tightening our top-to-bottom performance management. We are not managing for averages. If an area of the business is delivering 5% growth, we want to make sure within that we're investing to accelerate those sales that are growing at 6 or 7%, and we understand what we need to do to fix those sales that might be growing at, say, 1 to 2%. This is a sharpening of performance management at all levels of the business, and we're convinced it's one of the actions that will make the most impact on performance. And it's echoed in the category presentations you will see later today. Each presentation will give you an overview of the global category, but will also include a market case study, chosen to illustrate how we're accessing specific areas of growth. So to connect this to the actions Laurent talked about earlier, it means that for the first time, there's going to be executive board focus and accountability on the 30 or so most important sales across the group. This includes sales in the Expand the Winners category, where we're driving further rollout of growth platforms, such as pet care in AOA and our out-of-home coffee business, as well as scaling our big bets. This accountability and follow-up will also apply to the most important underperformers, including those big sales losing share, such as Nespresso Europe or Frozen Foods North America, which deliver good profitability, but are currently a drag on growth. We're also increasing the precision of the conversation about each cell and the data underpinning the diagnosis and the actions at all levels in the organisation. Laurent talked about this earlier, and he talked about using data to evaluate our value proposition, and the opportunity here is significant. What surprised me as we've started to execute is not so much how we score on our 60-40 taste preference metric, but the fact that we've recently tested it in less than a third of our SKUs. This is changing. So to bring it all together, we don't have a portfolio problem. We're confident in Nestlé's category growth of 3 to 4%, and we can do more to drive acceleration of our categories through consumer-led insights and innovation. And we can certainly do a better job of protecting and increasing our market share as a result of better execution for our consumers and customers. The good news here is we have so much opportunity, and we're clear on where to focus and what actions to take, and we're embedding a new level of rigor. It will take time, but it will have an impact. So moving next to margin. We have structurally strong profitability underpinning a UTOP margin above 17%, and our portfolio positioning supports this. For example, within coffee, we're more exposed to soluble coffee and portioned coffee, where profitability is much higher than in roast and ground. A second example is pet food, where today almost half our sales are in super premium products such as Purina Pro Plan with accretive profitability. And it's not just our premium products that are helping us build margin. The margin of our affordable offerings is equally strong. They're designed to deliver at the lower price point. And the same can be said of our e-commerce route to market, where we've engineered our value chains to deliver margins that are at a similar level to the rest of the business. Our structural margin profile is underpinned by the competitive advantages that Laurent talked about, the strength of our brands, breadth and depth of our customer relationships, our leading edge innovation, and our scale. Taken together, it means that we can deliver consistently for our consumers' needs at the right margin. Over the last 5 years, our management of profitability meant that our operating margin declined by less than our peer set. But we haven't been delivering our margin as a function of leveraging those inherent strengths that I just talked you through on the last slide. We had as much or more gross margin pressure than others, and that was mitigated by a reduction in marketing investment. So while we saw less impact on operating margin, we underinvested in future growth. If we now look at what to expect going forward, our starting point is guidance of around 17% for 2024. This slide shows the key moving parts from there over the coming few years. In the short term, we have a headwind from input costs, especially in coffee and cocoa, which should be mitigated through a combination of pricing and efficiencies. We've already been very clear that we will step up investment rapidly, and while longer term this will be funded through efficiencies, there will be a lag. That's why we expect margin to be down in 2025 and to build back from there. In the medium term, we expect to be consistently 17% plus, and I'm going to break down these drivers on the next few slides. First, on input costs and pricing. It's clear these are going to be a challenge in the short term. But as you can see on the chart, big fluctuations in input costs have always been part of our business. And we have a range of strategies open to us to deal with increasing input costs. First, of course, is taking price to cover increases. But sometimes we can't do that without moving out of reach of the consumer. In that case, we innovate to protect gross margin with different pack size or designing for a lower price point. And finally, of course, we look consistently to drive efficiencies to mitigate cost increases. Often, we're helped by the fact that we're better placed than our competitors to navigate some of these challenges. Taking coffee as an example, we have lower exposure to roast and ground and higher exposure to the more value-added portioned and soluble coffee, where green coffee is a much lower part of the overall cost. We're advantaged by our sheer size and deep, long-standing supply chain relationships. And our leading extraction technology has allowed us to consistently use more of the coffee bean, reducing costs and the burden on the planet. So we can benefit competitively even when there are headwinds. However, while we implement these strategies, in the very short term, the impact on margin will be lumpy because we can't pull all of the levers at the same pace as the movement in costs, especially given annual price increases. The next important topic is efficiencies. Laurent has been very clear that we need to invest without compromising margin in the medium term, and that comes from driving efficiency. We're approaching this with a high level of ambition, granularity, and rigor. For the past several months, we've been doing a very detailed benchmarking exercise, and that's not just internal benchmarks, that's against peers. And it's given us a very clear view on where we're best in class and where there are opportunities. So what's the outcome? Well, I'm sure you know that Nestlé has ongoing initiatives to deliver efficiencies of around 1 billion Swiss francs per annum. That will continue. In addition, we aim now to deliver incremental cost savings of at least 2.5 billion Swiss francs by the end of 2027, providing the fuel for incremental growth investments. To be clear, the 2.5 billion is a gross number, and while savings in procurement and commercial spend will not incur any one-off cost, some of the operational efficiencies will. And I'll give you more detail around all of that at the full year and a breakdown of the efficiency drivers and phasing and the costs to deliver. Importantly, we're very clear about holding ourselves to account to deliver on these savings, and we will report to you on our progress. And finally, it's important to say that our opportunities are not just about reducing cost. They're about running our organisation better, removing friction, increasing agility, and making Nestlé a better place to work. So turning now to investment. We need to increase the investment behind our brands. On marketing, that means getting back to a rate of 9% of sales by the end of 2025. And this is not about spending a little bit more everywhere. It's about significant targeted investments against our biggest growth opportunities. We will do this as fast as we can, where the limiting factor is business case and execution plan rigor. So to conclude on margin, Nestlé can consistently deliver 17% plus, including a step up on investment. So I'll turn now to cash flow and balance sheet. Nestlé has historically delivered strong cash generation. However, our cash generation from operations, and especially our free cash flow generation, has been lower over the last 5 years. Now, that's mainly for 2 reasons: the impact of higher working capital investment and the impact of higher CapEx. Going forward, driving cash generation is something that we are very focused on. So let's look at the 2 areas impacting cash flow. As you can see on this slide, CapEx has increased in recent years. And that reflects a step up in investment to bring on much needed new capacity, particularly in pet care and coffee. Having gone through a period of more elevated investment, we would expect CapEx as a percentage of sales to come down now from here. However, CapEx per se is not a bad thing. It's reflective of increased demand. The key point again is that we need to have the right rigor and discipline to ensure we're generating the right level of return on investment. The second factor driving cash conversion in the last few years has been working capital, which has increased as a percentage of sales as we navigated the supply chain disruption. Going forwards, we're optimizing our supply chain to a more neutral working capital position. So turning briefly to return on invested capital. I won't dwell on this side, but I do want to say how important this is to me. You've heard us talk a lot about rigor in respect of investments and ensuring that we're generating the right returns. And that will all ultimately come together in our ROIC. ROIC will obviously be impacted in 24 and 25 by the margin reduction. But then going forward, we'll see this improving as we drive stronger sales growth, margin recovery, and greater investment discipline. Turning now to capital allocation. There's nothing here that should come as a surprise. We've been very clear that our priority is investment in organic growth, although we see room for targeted bolt-ons in our growth platforms. On returns to shareholders, the dividend remains our top priority, with no change to our practice here. And we'll continue to return excess cash to shareholders via share buyback when we have such excess cash to return. And that brings me on to leverage. Again, no change to our existing policy. We're currently right at the top of our range of 2 to 3 times net debt to EBITDA. And I've said before, we would like to return to around the middle of the range. So we don't expect to commence a further share buyback when the current one completes around the end of this year. So I'll finish by bringing all of our comments on guidance together in one place. No change to our existing guidance for 2024. For 2025, we will provide formal guidance in February. However, I know this is an area of keen interest, so I want to give you as much help as I'm able to at this stage. On top line, the benefits of all of the actions we have underway will take time to come through. And we don't expect the consumer backdrop improving into 2025, although some of the 2024 headwinds should be behind us, such as inventory reduction and lapping consumer hesitancy towards global brands. On UTOP margin, we've already talked to the fact that this will be down in 2025 as we step up investment for growth faster than we unlock the incremental cost savings. At the 9-month update, we also said that we're not expecting the decline in 2025 to be in the range of 100 to 200 basis points compared to our 2024 guidance of around 17%. This still stands. So turning to the medium term, On organic growth, we aim to accelerate our categories and improve market share. And this will translate into 4% plus organic sales growth in normal market conditions, and will support us returning to a UTOP margin of 17% plus in the medium term. So to summarise, driving category growth and improving market share will be key. To fund our growth plans, we aim to deliver incremental cost savings of 2.5 billion Swiss francs by the end of 2027, in addition to our existing efficiency initiatives. We will be more polarised in our resource allocation and rigorously track the return. Improving cash flow generation is an area of focus, with significant opportunities to improve our cash conversion. And when it comes to capital allocation, our priorities will continue to be organic growth and dividend returns to our shareholders. And with that, I'll hand over to David for Q&A.